Hello traders, welcome back to the Forex Geek where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the pivot points, a time-tested technique, and it's an indicator used by professional day traders to identify key support and resistance level on the market. So stay with me until the end as I will show you exactly how to implement these levels into your daily trading routine for more consistent results. So we first start by understanding what the pivot points in day trading strategy is all about. The pivot points are the technical indicators that help you identify key levels of support and resistance based on the previous day trading section, either the high, the low, or closing prices. Now, these levels act as potential turning points in the market where price movement may reverse or consolidate. The main pivot point is always calculated as the average of the high, low, and close. Serve as the baseline. It serves as the baseline for determining a market sentiment, bullish above the pivot point and bearish below it. So this is the pivot point on the chart. The P represents the pivot point. So when price is above the pivot point, it means that we are in a bullish trend. We are looking for bullish opportunities. When price is below the pivot point, it means we are in a bearish trend. The indicators generate 7 levels. The central pivot point, which is this P point on my chart, it creates 2 resistance levels, which is the R1 and the R2. And it creates R1 and R2 for the resistance level. And it also creates 2 support levels, which are the S1, which is the support 1, and the S2, which is the support 2. These levels are plotted as horizontal lines on your chart, providing clear zones where price action is likely to react from. Pivot points are unique because they are leading indicators, meaning they predict potential price movements rather than the lagging behind indicators. As we can see from my chart, you can see the way price reacts from these pivot points on the chart. These are known as magical levels that make price react when price gets to this area. Now, the simplicity and the precision of the pivot points makes them widely used by both retail and professional traders across forex, stocks, and commodity markets. They offer an objective way to anticipate market movements without relying on subjective interpretations. Now, let's see how we can apply the pivot point strategy to our day trading lifestyle. Applying the pivot point effectively in day trading requires a systematic approach that combines technical analysis with disciplined execution. The strategy the strategy I'm about to share focuses on identifying established trends and waiting for price to pull back to the pivot point levels, and this method has consistently delivered results for traders across various markets. So how do we start? We start by setting up our charts. You put your pivot point indicator, your pivot point, this is the pivot point standard indicator. We place this on our chart. Secondly is to place 3 exponential moving averages, which is your exponential moving average, your 5 exponential moving average. This is your 5 exponential moving average would be the first one, your 15 exponential moving average. Just to tweak the color a bit, I'll change this to red. The 5 exponential average would have a red color, while the 5 exponential average will have a red color. The 15 exponential average will have a yellow color, while the 30 exponential average would have a blue color. So this is basically how we are going to set this on our chart. Now this moving average will help us confirm the underlying trend, direction, and strengthen your pivot point signal. Now this is a 5-minute chart, and we can see how we have plotted these levels on our chart, and you can see the way price are respecting this level. You see the way price reacts from these pivot point levels. As you can see at this area, this support 2, when price got to this area, you saw the reaction to the upside. And when price got to the support 1, you can see this reaction at this area. You can also see this reaction when price for the meantime reacted on this support, and it found it difficult to break this area before eventually it broke to the downside. The core principle of this strategy is trading the bounce from the pivot point levels in the direction of the established trend. Now let's say for a bullish setup, you have to wait for price to pull back to the pivot point. Now let's look for a bullish scenario. Looking for a bullish scenario in the market, we can see in this area of the market, this is a bullish scenario. Let's look for where perfect. This is a bullish scenario, and you can see we will have to wait for price. This is, you can see, even using your trend line, you can see from this area that price is trending to the upside. This signifies that yes, we are in a bullish trend. So plotting your pivot point indicator on this chart would further help us to find out areas where we expect price to react from. Now we'll have to wait for price to pull back to the pivot, the central pivot point, which is this P point. If you can look very well, you will see this is P. So wait for price to come back to this P point. When price breaks above it, remember in a bullish trend, price would have to be trading above the central pivot point region. So when price is above it, wait for price to pull back to that region. When price pulls back to that region, or you can also wait for price to pull to the support 1, but as you can see, the support 1 is a bit far away. Price did not pull back to this area, but when price pulls back to the central pivot point in a bullish trend, your entry signal will occur when price touches the pivot level and shows signs of rejection with a bullish candle that engulfs. As you can see, when price pulls back to this area, you can see there were a lot of rejections. There were a lot of rejections before price broke above with a bullish engulfing at this area. When price broke above at this area, this would be a good time for you to enter your trade. You would want to enter your trade, or you can typically wait for price to break above this structure to further solidify your setup to avoid minor fake outs. But if you enter at the break of this particular high that was being created when price was reacting from this central pivot point, when price breaks it with a strong bullish engulfing candle, you can wait for price to retest and you enter your trade. When you enter your trade, you put your stop loss just 5 to 4 pips below your recent swing low, and as you can see, this is your recent swing low at this area. Just set it 5 pips below that area and you are good to go. You would aim for a minimum of, your take profits can be 1:2 or 1:3 risk to reward ratio. You can also target your next level. You can target maybe your resistance 1 can be your next, can be your take profit zone, which will be a 1:3, or you can target your resistance 2. So let's look for a bearish scenario, because for a bearish setup is typically the same thing. You just look for price to be below your central pivot point. Let's look for a bearish scenario. Okay, perfect. Now this is a bearish scenario when you can see, as you can see, market is trending to the downside. At this area, we can see from the trend line that we are creating series of lower highs, lower lows, lower highs, lower lows. So this signifies Even using your moving average, you can see that price is below the moving average at this region. So remember, the first step is to wait for price to confirm that we are in a downtrend. You can use your moving average, and as you can see at this area, price is below your moving average. We have to look for price to pull back to our central pivot point or our resistance 1. Now as we can see, when price broke through this area, price pulled back at this region. When price pulled back at this region, this would have been a very strong confirmation. Remember, price is typically below our moving average, which signals that we are in a bearish scenario. Price then decided to come back to retest our central pivot point. Remember your pivot point. When price came back to retest that, you wait for your candlestick pattern, your bearish engulfing candlestick pattern, to signal for you to enter your selling trade. Now when your bearish candlestick pattern has showed, you decide to enter the trade at that region. You place your stop loss just above that area in price, just above the last swing low. You put it 5 to 10 pips above that area. 5 pips is very okay, making it a total of 10 pips, a total of 20 pips. Then you can aim for 1:2, or you aim for the next support region for your take profits. As easy as that. Remember, the timing of trades matter significantly with pivot points. These most reliable setups occur during the first 2-4 hours after a new section begins. That means the first 2 hours after your London section, or the first 2 hours after your New York session. And as you can see, this trade, it happened during our New York section. You can see at this area, it happened during our New York section. This happened during the late London sections, beginning of the New York section. Remember, to validate your pivot point signal, you can use your volume indicator. You can always use your volume indicator. So applying our volume indicator, we can see if we are backed up by volume. And as you can see in this area where we decided to take our trade, if we look at the volume bar, we can see that there was an increase in volume. The bearish movement, there was an increase in the volume. If you can notice from this area, the trend was to the downside from the volume bar. The next thing, the moment we spotted our engulfing candle, we can see it was backed up by volume. This further strengthens our market conviction and improves the reliability of our signal. Conversely, a pivot point test with low volume may indicate a weak reaction and potential for a level to break. This strategy works best in ranging or moderately trending markets during extremely volatile conditions, or when the market is experiencing a strong directional move. Pivot points may be broken easily, rendering the bounce strategy less effective. Always adapt your approach based on the current market condition. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. And if you found this video helpful, do not forget to like, share and subscribe. Turn on your notification bell so that you will never miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.